Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
All right, so what we have left here is how can you use a butterfly as a cheap alternative to calls or puts, and also roll that into a volatility play. And what we have here is buying out of money calls. Now, for the sake of fairness, the examples that I was using before, they could be easily applied to most of the, to several FX option underlyings or even equity underlyings with narrow strikes. This example is more suited towards an equity, but I thought it was relevant, so I kept it into this presentation. But I just wanted to kind of, make that known. I realize most underlying currencies are not going to move from 158 to 180 in 2 months. So let's take a look here at the math. Let's say you think the stock or the underlying can go up significantly in the next 2 months, move from 158 to 180. Very, very bullish here. One thing you can do is buy 10 out of the money calls, of the 170 calls for a $6.80 debit. That would cost you approximately $7,000, including commissions. If you are correct, at expiration, those 170 calls will become worth 10 bucks, and that would give you a net profit of $320. And so that would be a nice profit at the end of the day of about $3,000. Let's look at another scenario on slide 32. Same outlook, right? But here, instead of just buying 10 of the 170 calls, on top of that, you're going to sell 20 of the 180 calls, which corresponds to the target price that you have of 180 in your forecast. And you're also going to buy 10 of the 190 calls. This is a long butterfly spread, but the difference here is this is an out-of-the-money spread. Why is it out of the money? Because the options you're selling, that 180 strike, that is out of the money relative to where the underlying is today, which is 158. You can do all of that for a dollar debit, and that would be your maximum risk. If you are correct, as in the previous example, and the underlying moves up to 180, that call fly would become worth $10. All right, you paid a dollar for it, and that would give you a net profit of $9 per butterfly spread. If you did 10 of those, that would be just under $9,000 when you include commissions, which would be a pretty handsome sum. On slide 33, we talk about the pros and the cons of doing this. Okay, so let's look at the long call first. If you buy the long call by itself, what do you have? You have unlimited profit potential. You only have to deal with one option, so that's one commission and one bid-ask spread to contend with when getting in and out of the trade. You have to consider all the costs and all the maneuvers for your strategy when trading. So this is definitely one that is an advantage here. On the cons, though, for buying just the long call by itself, you do have higher risk. You're talking about putting up risk of $7,000 when buying 10 contracts. As time passes, it will decrease the value of your call. That is the natural behavior of options to decay as time passes, as each day moves on. And the other thing that comes into play here is that as underlyings move up, implied volatility of the options based on that underlying tends to decrease, and that further reduces the value of that option that you would own if you just bought the long call by itself. On slide 34, we talk about the pros and cons of the call fly, and what you have here is the pro here is that it's much lower risk. a per contract basis is only $1 versus close to $7 in buying the call outright by itself. You still have a high reward, right? You can still make $9 on that trade. 9 times my investment, I would consider that pretty significant, even though it's not theoretically unlimited. You want to look at what's actually practical, and as we know, stocks do not just go up in an unlimited fashion. Another benefit here is that this trade actually benefits from the passage of time, unlike the long call does. And it also benefits from a decrease in implied volatility because you're selling twice as many of the 180 calls than you are buying the 170 or the 190 calls. On the downside, though, this trade does have limited profit potential. It has a narrower profit range, so the likelihood of you hitting the home run and making that $9 is very low. However, you do have a pretty good chance possibly of making something on your $1 investment. But that all depends on the marketplace and, what the environment is for that specific trade. And then finally, because you're trading a butterfly, you have 3 commissions and 3 bid-ask spreads to contend with for that trade. So you need to evaluate all these different characteristics and see what works for you when making your trades and if you're really bullish on a particular underlying. Just want to summarize here something that's really critical when you're trading FX options. These involve specific consideration to GDP of not only the U.S. but also the currency you're trading it. Because you're always making a play as to one currency is increasing as the other currency is decreasing. There's always that relationship. And you all are looking at things that impact that, such as GDP, interest rates of both countries, the international trade environment, what's going on in that country, unemployment, is there any political turmoil, is there inflation, what are the big picture items, which is much, much different than if you're trading an equity option where the most of the focus is on, earnings and so on. There's a lot more to consider with FX options. I believe on slide 37, 38, and 39, I've just listed here several of the questions that I receive in the past when talking about butterflies. I wanted to include them here, but at this time, I can open it up for any questions that anyone might have, and really want to thank everyone for their patience in dealing with the technical difficulties. I hope you're still able to come away with some meaningful lessons here about butterflies, and if there's any questions or anything I can help you with, please contact me at webinars@TradeKing.com. My name is Nicole Wachs, and it's been my pleasure to be with you today.
Nicole, thank you so much. My apologies that we had problems with WebEx, and most of the attendees hung in there, so that's really just a testament of how interested they were in butterflies and the idea of basically looking at hedging risk in a certain way as you went through. Lots of ways to trade options, and butterflies might be one way that some traders / investors can implement their forecast with limited risk. So let's take a look and see if there are any other questions. Trying to see if there are. Question here from Tina. Maybe you handle this, I'm not certain. Is it more difficult to get into a butterfly than a single leg call option or put option, Nicole, in your humble opinion?
It has more working parts, so I would say it is more difficult. I wouldn't say a lot. Once you understand the trade, which is the most important aspect here, you can trade a butterfly spread on TradeKing just as fast as you can trade an individual call or put. Pretty close to just as fast. There might be, 2 extra clicks on the same page, but pretty much it's fairly straightforward. But the more important issue is you got to understand what you're trading no matter what. That's the main thing.
Very good point. Nazim has a question. He says, what is the best way to exit this butterfly, or do you hold on till expiration? What's your view there, Nicole?
That's a great question. I'm really glad somebody asked. It's similar actually to David's question about, why not hang in till the end and make the 2,500, which was the maximum in that example. The best way really is to exit the butterfly in its entirety. It really depends, though, on where the underlying is when you're getting out. If the underlying is close to the at-the-money strike, as you approach expiration, but you're still, say, a couple weeks out, then you would exit the whole spread and just close out everything. You would sell it as a butterfly, just as you got into the trade as a butterfly in that case. I would not usually hold through to expiration if I entered the trade as a butterfly, because the likelihood of making that gain in going through the very unexpected period of options towards expiration is just unlikely. So I'd rather take like a 30 to 50% return, which is common. It is very possible on a butterfly trade of making 30 to 50% on a trade in a few weeks' time. I'd rather take that than trying to make 900% in the last week and lose everything. The issue is, though, that the butterfly spread is a smaller dollar amount that you can make, and so that's definitely, people kind of shy away, but you got to really look at the percentage, the return on investment there. That's the critical factor.
That makes sense. That makes sense. It looks like we've run through all the questions, Nicole. I'd like to give you just a moment or two for any closing comments that you might have.
Sure. I just, one of the questions that we get about butterflies often is, the downside of butterflies is the narrow profit range. If I make the strikes wider, will that improve that profit range? And it will. It will improve the profit range. It will improve your probability of success. The difference is, though, that the amount of risk you're taking on will increase, and the debit that you pay will be right there along with it, will also go up and increase, so it'll be a more expensive trade to put on. So it's always a balancing act of, risk and reward with options, and it's no different with the butterfly trade. If you have any questions at all about anything options related, or we also trade stocks at TradeKing, and so on, and other equity products and bonds as well, please contact us at webinars@tradeking.com or visit us at tradeking.com/education. My name is Nicole Wachs. I handle education for TradeKing, and if you have anything you'd like to see from us, I'd be happy to see if we can meet that need. And thanks very much for having me with you today.
Nicole, thank you so much. Really appreciate it, especially under these difficult technical issues. But you were just a champ that you were able to sustain through that, so that was a difficult one. But thanks so much. Looking forward to you coming back, and hopefully we're having that we won't have any technical issues. But thanks again, Nicole. Really appreciate it.
Thank you, Steve.
Take care, Nicole. That was Nicole Wachs from TradeKing. And if you're interested in learning more about what TradeKing has to offer, let me just go back. They have webinars, and you can get a copy of the presentation at webinars@tradeking.com. And they have, Nicole, you still there?
Yeah, I'm still here.
Okay, yeah. If you like to go through your webinars, that'd be great. You could just talk a little bit about your webinars that are today, or the upcoming webinars, I should say.
Sure. We have our webinars every Tuesday at 5 p.m. You can access them by going to webinars.tradeking.com. And today's session will be by Michael Kahn, and he will be handling basic chart patterns. Everyone should know. Next Tuesday we will have income strategies. Actually, next Tuesday event has changed due to a scheduling conflict. I will actually be presenting on some trader lingo basics. on February 22nd. And then on February 24th, we will have a special Rookies Corner, which is our beginner session on covered calls and the risks.
Sounds like a great lineup, Nicole.
Thank you.
Nicole, thanks so much, and I look forward to you coming back real soon. Just want to remind everyone that we have another webinar coming up at the ISC. So please join us for Dan Passarelli. Dan will be talking about setting up option strategies using ETFs, and that's going to occur in just 30 minutes. So please join us there. And next week, we have other webinars. You could sign up to the ISC, www.isc.com, and we have all the webinars there. So I want to thank first I want to thank Nicole Wachs. Nicole, thanks so much. I want to thank all the attendees for attending and for hanging in when we had such difficult technical issues. Hopefully that won't occur again. Thanks again, and you can come back and listen to the whole presentation, www.isc.com/webinars, or you can go to www.isc.com/archives. Either way, you can get the presentation. So please join us again in just 30 minutes. You have to just log out and log back in, and Dan Passarelli will be talking about setting up option strategies using ETFs. So thanks again for joining us, and please come back either at Dan's session in a half hour or for next week's sessions. Thanks so much. On behalf of the ISC, Steve Meisinger wishing you a safe and happy trading day tomorrow. Bye all.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.